topic is transfer pricing in post-COVID era 2020. And today what we are going to discuss is not just the last topic, but probably the most important topic in an arm of international tax. Well, we all know that the ongoing pandemic will disturb supply chains, forcing multinational corporations to rework with consequential impact that will shift risks and profitability besides the impact that it will have on their overall businesses. We have a very interesting panel today. The panel will look into analyzing what is really the impact of COVID-19, not just from a business and a commercial standpoint, but also from a transfer pricing law standpoint, more importantly. We shall identify commercial and financial risks that typically get into a business. My colleague from Vienna University, Dr. Raffaele Petrosi, has a very interesting case study on a pizza company. What happens after months of lockdown of pizza business? What really happens insofar as the pricing is concerned? How do you go about selecting the application of most appropriate methods, say for instance, in a royalty transaction? More importantly, we are also going to debate after the pizza company example, what is the need of the hour today? And we have analyzed various business models. Need of the hour in terms of what happens to a contract service provider, including a contract manufacturer. What happens to a typical distribution model, including value-added distributor? What happens in an entrepreneurial manufacturing function? What kind of issues are involved from an economic analysis standpoint, from an Indian transfer pricing regulation standpoint, and more importantly, from the point of view of advanced pricing agreement? Interestingly, these could be negotiated and finalized advanced pricing agreement, or it could be advanced pricing agreement for which negotiations are in place. Besides Dr. Raffaele Petrosi, I am also pleased to introduce Mr. Shobhan Kar from Indian Revenue Services, two of my learned colleagues from the profession, Rahul Mitra and Karishma Patafekar, and from the other side of the globe, Graham Wood, who is the Global International Tax and Transfer Pricing Director of Procter & Gamble. We are also going to be joined by Dr. Justice Vineet Kothari, serving judge of the Madras High Court, and he is going to help us sum up the presentation. Today's technical session is for 90 minutes. Thereafter, we will move over to listen to the last valedictory address, which, as most of you are aware, will be delivered by Mr. Harish Salve. So with those few words, over to you, Raffaele, and thank you very much for joining for this important webinar.
Thank you very much, Mukesh. Thanks for the kind introduction, and good morning, good afternoon, and good evening to everyone joining for this event. First of all, I would like to thank the IFA India, Mukesh, and his team for the kind invitation, but also for the great job done in order to put up this really important event. I would like, before we start discussing about this topic, also to highlight that you as participants should have received an interesting paper written by my two colleagues, Saib Rasan and Gabriela Capristano, on this topic. So I think if you want further details on this, you are free to read that paper that will soon be published. We talk about transfer pricing in the post-COVID era. We know that there has been already many discussions on this, and of course, the international organizations are also working on this topic. We'll try to set up some of the issues that are there by means of a case study. So when we think of a transfer pricing analysis, and we think what are the various steps that need to be performed when having a transfer pricing analysis of any kind of transaction, we think that there are different ways in which COVID-19 will impact these analysis. When we think of where this crisis might have most of the impact, this will be most probably on the recognition of the transactions and on the application of the method, typically the various benchmarking analysis. However, there might be an impact of these crises also on delineating transaction as well and selecting the most appropriate method, although this impact should not be a major one. So I have prepared an example which will bring us through the various issues. This example, of course, refers to pizza maker company, but this could be extended also to other companies out there. So the example is the following. Delicious Pizza is the Indian subsidiary of Pizzageddon Group, an Italian food M&E who produces and sells pizza all over the world. The group is famous for the unique taste of its dough and employs 10,000 pizza makers in 50 different countries. Before the COVID-19 lockdown in India in March 2020, Delicious Pizza was employing 500 pizza makers. Out of those, 20 were Italian pizza makers specifically hired by Delicious Pizza's local R&D department in order to customize the taste of the pizza in the local market. Based on the 2019 DP documentation, Delicious Pizza is functionally characterized as a full-fledged manufacturer and distributor. It pays royalties to its Italian parent company in order to receive the famous original receipt of its pizza. However, based on DEMP analysis, Delicious Pizza is entitled to part of the R&D related return coming from the Indian sales, since 20 pizza makers significantly contribute to the local improvement of the receipts. When the COVID-19 lockdown in India was announced, Delicious Pizza had to close all its branches. All the 20 pizza makers, I hope you can see the animation here, flew back to Italy in order to stay with their families until the lockdown was over. During this period, they kept working from Italy for Delicious Pizza. Now, the question that might be raised here when we discuss about the identification of commercial and financial relations and the delineation of the transaction is what happens to the DEMP analysis and the royalty payments in the 2020 TP documentation under the assumptions that the 20 pizza makers will work for Delicious Pizza from their home in Italy, or eventually they will go to work from Pizzageddon headquarters R&D department. Based on these questions, I think the answer to this is that the DEMP analysis should not change. The 20 pizza makers are still working for Delicious Pizza, although they are working from Italy. There might be some issues eventually when they work from the Pizzageddon headquarters R&D department, issues related to permanent establishments, but we will not discuss those issues really deeply, although, of course, some issues of permanent establishments might be raised in Italy. Now, the second step of the analysis, we said, is the recognition of the transaction. And we have the following facts. After some months of lockdown, the Pizzageddon Group decides that it is better for the 20 pizza makers employed by Delicious Pizza to be employed by the headquarter R&D department for various reasons. For example, avoidance of the risk of PE, or there might be some other labor law issues. From a transfer pricing perspective, in 2020, Delicious Pizza will not perform any longer the DEMP functions, and consequently, all the R&D related returns coming from the Indian sales will be attributed to the Italian headquarters by means of increased royalty payments. These changes will stay in place for the rest of 2020, and 2021 is uncertain. Now, the question that might be raised in here are much more having an impact on the transfer pricing analysis, because Someone might question whether the change in the TP policy made by the company should be recognized as such by the Indian tax administration, whether it does have commercial rationality for the company to shift the pizza makers to the headquarters, or whether instead the Indian tax administrations should disregard those changes from a transfer pricing perspective. And eventually, the question that here could be raised as well is whether this might constitute even a business restructuring. So, of course, here those questions will highly impact the TP policy of the group. And in order to answer those questions, someone should ask himself, first of all, whether there are some clauses in the contracts between the associated entities that would refrain such changes. If not, whether this is at arm's length, that you don't have any clauses in the contracts to prevent these changes. Whether under the commercial laws of the countries, those changes would be refrained. Also, whether this makes commercial rationality, also whether it makes sense to move those employees from Delicious Pizza to the headquarters of the company, whether there is any profit potential eventually connected to this movement, and last but not least, if we assume that this will not make any business restructuring issues because it's only a temporary movement, then for how long this movement can last until it does not make any issues. Of course, the main risk that you have in here is that the Italian tax administration will consider those changes to be effective and therefore to give rise to higher revenues in Italy because the DMP functions are now performed by the Italian headquarters, while the Indian tax administration, on the other hand, would disregard these changes and still think that the DMP functions are performed by the Indian entity, and therefore the royalties should not be increased. If we think, therefore, at the next step, at the selection of the most appropriate methods, sorry about that, okay, this is the right slide. Let's assume now that from a transfer pricing perspective, the changes in 2020 are not recognized by the Indian tax administration, hence the DMP functions are still performed by Delicious Pizza. And when it comes to the most appropriate methods to price the royalty payments from India to Italy, based on the 19 documentation, Delicious Pizza had selected the transactional profit split method due to numerous reasons. Now the question is, since those employees are now in Italy, still working for Delicious Pizza, should this choice be reconsidered in 2020? Well, the answer here is clearly no. If the functional analysis and the DMP has not changed, then the selection of the method should not change, and we should not move to another method only because we have employees in other countries. Last, we have to apply this method, and of course, when it comes to the application of the method, to price the royalty payments from India to Italy based on the 19 TP documentation, Delicious Pizza should pay to Italy, to the Italian parent, a yearly 10% royalty fee. However, in 2020, due to the decrease of sales in India, as well as in the rest of the world, this has resulted in significant losses for Delicious Pizza, as well as for the rest of the group. So the question here is whether the royalty fee should be redetermined in light of the new economic circumstances, whether basically the previous selection of the method should be reconsidered in light of the new economic circumstances. And of course, here, as we said before, even in light of the new economic circumstances, the method should not be changed. And if you will select the transactional profit split method as the best method here to apply, it should be that method to be applied. When it comes, however, to the determination of the royalty fees, this might be reconsidered in light of the new economic circumstances. Now, the question that everybody is asking is which benchmark can we use in order to price those royalties? Can we take benchmarks performed in the past years and make adjustments? In the case of those adjustments, what adjustments can we make? Eventually, can we learn something from previous crises? For example, the previous financial crisis that started in 2008. And eventually, can we take the data from the past years, but then adjust them in the future as far as we are on time for making those adjustments before we close the tax returns of the company? So these are all questions that will impact this part of the analysis. So just a few conclusions on this topic. First of all, the changes due to this COVID-19 crisis will most probably impact all the relevant transactions. So if, for example, we think at financing, we have to ask ourselves whether companies during this crisis will still retain the same ability to have loans from their associated entities, or whether those loans will be recharacterized as equity contribution in light of the fact that some companies might lose also financial strength during this crisis. What will be the interest rate? This is another issue that should be defined. So all the various transactions will inevitably be impacted by this crisis. What would be the impact on the OECD projects on digital? Of course, this is an important question, since this crisis has shown us that not all the so-called highly digitalized businesses are the same. We have seen, on the one hand, Amazon increasing a lot its value during this period, but on the other hand, companies like Booking.com that unfortunately have not performed as well during this period. What will happen to the definition of amount B, for example, in definition of the safe harbors once the economic circumstances have changed during this crisis? Other issues might be what will be the risk of the PE, what will be the impact of this. We have seen the OECD clarifying that there should not be too many issues or permanent establishments, since these changes are only temporary, but for how long these changes will last, we still don't know. Eventually, other question will be what will be the impact eventually on custom valuations or even on indirect taxes of this crisis. Last but not least, of course, the solution to all this will be an improvement in the dialogue between taxpayers and tax administrations. But of course, once you agree on this dialogue, please don't shake hands, but use all the other ways to agree with each other that we have learned during this period. So this was it for my presentation. I think what we can do now is to start asking questions to our panelists. Maybe we can start with you, Graham, and maybe the question for you would be, what do you see as the main factors related to this crisis that will impact the transfer pricing policies of MNEs in general?
So, Raphael, thank you very much. Thank you for the simple question. Very easy answer, I think, to that one. But before responding, I think let me just repeat my thanks to Mukesh and fellow panelists and IFA India for the invitation to be part of this prestigious panel. Hopefully, I'll be able to provide some valuable input to all of you who are on the session today. Maybe first, in case you're confused by my accent, I'm with Procter & Gamble. I'm based in the US. I'm originally from the UK. I've spent over 30 years with P&G and have spent more than half of that time in the US. And I've been P&G's transfer pricing leader since 2006. So just a little bit about me with regard to my background. I think as Raphael summarized at the end of his session, I think the impacts of COVID-19 basically go across almost all transfer pricing aspects in terms of both sort of one-off impacts, transitional impacts, as well as going impacts. Now, the impact of COVID-19 is going to be very different for different M&Es. It's not a case, I think, of one size fits all. And before I talk a little bit about some of the specific things that need to be thought about, what I would say would be that let's just think through the differences in potential impacts for different M&Es and perhaps the areas of consideration from a high-level perspective that each M&E needs to take into account. So first of all, obviously, the impact on different industries has been very different. I mean, as Raphael referenced, there's been a great increase in online shopping. Hospitality has really gone by the board during this period. We've had shutdown of manufacturing in certain industries, such as the auto industry, increased demand for digital capacity. Now, they obviously have very different impacts on those different industries. From my personal perspective, with regard to the company I work for, we're in the daily use consumer products business. Most of our products are seen as being essential to the cleanliness, hygiene, and health of consumers, and hence the impact of the crisis on our business, while it's not been zero, it's not been huge. So I think we've had some impact, but we've not suffered the dislocation which perhaps others have faced. I think the second area, in terms of the impact of the crisis on different M&Es, is it depends on your supply chain. Where does your manufacturing take place? Where are your products sourced from? Where are those products ultimately sold? I think where you've got a global supply chain, like many M&Es have, perhaps with a significant footprint in China, the impact may be more acute than where you've got much more of a regional or local focused supply chain. Again, in our case, our supply chain is largely regional/local. We do have significant manufacturing operations in China, but those are for the China market. So again, I think you've got to think through, if you're talking to an M&E or if you're with an M&E, the impacts are not going to be one size fits all. Depends on what your supply chain looks like. Similarly, the impact will depend on what your operational structure is. So see Raphael's example looked at the situation of a setup between Italy and India with some local flavoring taking place in the Indian market. There's going to be differences here with regard to how you operate your business. Is your business run on a global basis? Is it run on a regional basis? Is it run on a local basis? And the impact of the crisis are going to vary, linked to how you operate your business and also how your supply chain operates. I think the third area that I think people forget about when they're thinking about what is the impact of COVID-19 is, how do you manage your tax affairs? Right? So how important is certainty? Are you managing for the short term? Are you managing for the long term? As an M&E, are you chasing every last dollar of tax savings? You're trying to optimize your tax results each year, or you're thinking about the long term? Those things, I think, it's a choice. It really falls down to each M&E. Now, I would say in our instance, we made a decision many years ago that we have something where essentially we believe that our tax outcome will follow how we operate our business, and therefore the sort of swings and roundabouts of the business are reflected in the outcome of our operations after tax. We do want to try to seek certainty. We operate through a highly substance regional principal model with essentially managed margin regional manufacturing, country-based distribution entities. That's not the case everywhere. There are exceptions in places such as India, China, etc. I think the way that we are thinking about this, at least at the moment, and obviously we'll continue to monitor the situation, is we would take a stay the course action. So we're not thinking that there will be significant change arising out of this for us from a transfer pricing perspective. But there are still important things that you need to take care of. You need to monitor how your managed margin entities are doing. And then if I think about this from a general perspective, there are a lot of questions that come up, which I think Rahul is going to address in more detail later on in his session. You know, are your managed margin entities low risk or no risk? What risk should they have? How do you deal with comparables? How do you deal with one-off costs? What happens with government subsidies? How do they get reflected in the handling of your transfer pricing? The contractual aspects, which I think Raphael mentioned, where you have people in the wrong place, there's a short-term effect and there's also a going effect. What happens with donated products? So there are a lot of things that you need to take into account. As I said, it's not a one-size-fits-all. It's very much you need to understand your business and think through also what is your objectives with regard to your business in terms of managing your transfer pricing. So with that, let me hand it back to Raphael.
Thank you very much, Graham. I think it was quite not an easy question, but it was a really complete answer from your side. Let's see what Soban also sees from the tax administration perspective. What will be the reaction to these new challenges that COVID-19 will pose to transfer pricing issues? Whether tax administrations, not only in India but around the world, will react by having an increased scrutiny to grant, at least in the short term, more tax revenues, or whether there will be a push for an increased cooperation with taxpayers to grant, on the long term, more help to the businesses that need this in those circumstances. Saban.
Thank you, Raphael. Good evening to you. And before I start, I would like to thank Mr. Mukesh Butani and IFA for inviting me to this panel. From the government side, what I would like to say is COVID-19 is an unprecedented situation that all of us are facing. The whole world is facing this crisis. And so transfer pricing issues will come up, and I'm sure governments, I can speak on behalf of the government of India, we are sensitive to all the issues. We are listening to taxpayers these days because, as Graham said, the impact of COVID-19 is going to be asymmetric. There would be regional variation, there would be sectoral variation, and even if you look at product, there would be product-wise variation. As Graham very nicely said, products in the health and hygiene sector have actually seen a boom in their business during this crisis, whereas there are numerous other areas, other sectors where they could feel the harsh effects of severe lockdowns across the globe. But I would like to say here that, you see, transfer pricing principles will not change, and the guidance available to us, both in domestic law as well as in the OECD guidance, they remain the same. Concepts like economic analysis, accurate delineation of the transaction, these things won't change. So I am certain, and certainly on behalf of Government of India, I would assure everyone that we would be willing to relook at if taxpayers relook at the transfer pricing arrangements, we would be sensitive and be willing to understand what has happened, how they have been impacted. But of course, taxpayers would need to do the work. They have to do the diligence. They have to provide us with documents. They have to give us comparatives drawn out from the markets where they operate. So if everything is brought before the tax officer, before the TPO, then there's no reason why a change in arrangements cannot be accepted. How and why it would happen would be dependent on the facts of each case. I would also like to mention here that India as a country has not marched ahead and issued some guidance because these are early days. The crisis has still not played itself out. I think we are in for a long haul, and anything about financial year 2021 would be known only sometime in 21 when we sit down and start doing an economic analysis. Now, at this juncture, I would inform the audience that the Working Party 6 of OECD has taken it upon itself to look at the issues. They have come out with a questionnaire for the business community to inform countries and delegates of the Working Party 6 to tell us about the various issues they're facing due to COVID crisis. So there's an internal discussion happening in the Working Party 6. I cannot at this point say whether there will be anything new coming out from there, but there is certainly an interest. People are aware of the issues, and we are trying to learn more from the taxpayers. And maybe 6 months down the line, the Working Party 6 might also be able to provide some additional guidance or maybe knowledge sharing between countries, which would throw up ideas to tax administrations across the globe to handle similar situations similarly, so that taxpayers at the end of the day do have the certainty in their pockets. Thank you.
Thank you
Before you just
absolutely.
Sorry. I just wanted to interject for a minute. Dr. Just Kothari has joined, so I just wanted to welcome him again. He joined a little late, but that was the only intervention. Go ahead, Rafael, please.
Thank you, Mukesh. Just was thanking Soban for his points made, and I think it's really important to underline that there is a positive approach and attitude by the tax administrations towards this situation, that there is openness in talking to businesses. Of course, it is important also the taxpayers do their homework and prepare the documentation as it should be done, but at least it's also important that there is a positive attitude towards this by tax administrations. And it's important that also the international organizations are aware of these issues. They are working on providing guidance on this topic. So we will look forward to see what will be the results of the work of the OECD on this topic. Maybe we can move to Karishma with a question for you from an advisor side. What do you think there will be the measures that should be put in place by taxpayers and tax administrations in order to strengthen the compliance with the arm's length principle?
So, Rafael, I was mentioning that in the last 20 years of transfer pricing practice that I'm doing, this is the second situation we've, come across. The first one came in 2008 when the global crisis happened. This one in the COVID situation is slightly more intense. It seems to be there, for a longer haul that we all are talking about. As a transfer pricing practitioner, or an advisor, I would rather focus, today on the approach that we have for transfer pricing documentation as substance, more of substance than form. I would suggest that when we are doing our transfer pricing documentation, for the taxpayers, we should focus on a lot of the business related and the functional related aspects that are changing because of the economic situation. We should also focus on contemporaneously evidence gathering, because I think that will be crucial. Just to say that this is how my transfer pricing policy has changed is not going to stand the test of time in courts. We will really need to give evidence in terms of actual data, in terms of how the functional analysis has kind of changed, how the economic circumstances affecting the industry have changed. So first of all, that's the critical portion that we need to focus on. The second aspect I would also, lay importance on is is a need to reassess the existing intercompany agreements, in the context of the revised allocation of FAR or economic circumstances. Because I think it will be very critical to evaluate, what your contract terms are. Do they enable you to renegotiate? Do you have, termination clauses which can help you rewrite contracts, like the force majeure clauses, that typically would be there in third-party contracts. So that's on the intercompany agreement side. Then on the comparability and the economic analysis side, there are a couple of approaches that one can look at. One is, of course, making an economic adjustment to the comparables data, because typically as transfer pricing practitioners, we generally have limitation on the current year or the contemporaneous data, and we use past data to do benchmarking. So I think, we will also need to analyze the impact of this slowdown and impact of it on profits of businesses in different industries, and make necessary adjustments to the past comparable data. And, another critical aspect, I believe, is that we also need to align our local strategies to the overall global business documents that we prepare from a transfer pricing perspective, like the CBCR and the master files. And we need to align all of this more from a global perspective than look at it only on a local standpoint. So these are some of the measures, I would say, from a tax advisor perspective, that I would focus on, and of course, we would discuss some of those nuances in Rahul's section. But just, Rafael, there are one or two points on your presentation which are important, that I would like to comment on. Is you mentioned about in your case study about whether the movement of the people R&D department, whether that structuring. Now, this is a very, very sensitive and touchy issue from an Indian perspective, I would think, because business restructuring has been included as a related party transaction under the Indian transfer pricing regulations since 2012. And there is no definition of what a business restructuring will constitute, but we do have some guidance from our Institute of Chartered Accountants, which say that we should rely on what the OECD talks about business restructuring. And when you go to what the OECD talks about from a business restructuring perspective, you have para 9.1 that defines what business restructuring is, which talks about essentially cross-border redeployment of the FAR. So in your example, if the redeployment of the FAR is on a temporary basis, I would say it's not so much of an issue. But let's say, because of the situation, the company realizes that it's better now to kind of have these, employees located in Italy headquarter department, and it's more a permanent, phenomena. Then I think the question to ask is that even after these employees are shifted, to the headquarters, who are really controlling these employees? So if the answer to that is India, then I think, first of all, you can't change the methodology, because then you're talking about your critical aspect that you discussed about recognition of accurately delineated transactions. So in that context, I would say that, you need to continue to compensate the Indian entity. But let's say if the control moves to the Italian headquarter company, then, you would need to test whether a remuneration, like an indemnification for renegotiating or terminating, these things are relevant, and something like a one-time exit charge is something that the Indian tax authorities may ask. So but let me kind of give it a statement. As per again the OECD guidelines, you can't presume that all contract terminations or renegotiations give right to indemnification of arm's length. So I think the moot question will be that how would you behave in a third party situation, and that is absolutely critical to answer, because if you have evidence to show that in this COVID kind of situation you've also renegotiated contracts with your third parties, and this is also a behavior or a business or a strategic change, or it's more business circumstances, then I think there may not be a need for like a charge. So it's very fact specific, but this is definitely the business restructuring angle will become absolutely critical to evaluate in this situation. So over to you, Rafael.
Thank you very much. I think those comments were really important for both businesses and tax administrations. But I think that there might be reaction, an immediate reaction from Rem on this, or from Soban, if you have any.
Rafael, yes, a couple of comments from me, both with regard to the comments from Shoban and also those from Karishma. I think first of all, just with regard to Shoban's comments, I think from a multinational perspective, I think it's very, very encouraging to hear the comments around listening to taxpayers. I think that's great, and I think that will hopefully mean that at the end of the day we will have something which works. Because what I think we realize is what is really in the interest of everybody here is to get the economy moving, and is not to put things into a situation which is effectively stuck with regard to controversy. I also would agree with his comment, by the way, that transfer pricing principles, I don't think they really change. I think you still got to follow the transfer pricing principles, which I think were very well put by Karishma in her comments. I think what, to me, I think is very, very important there is to think about things from a contemporaneous perspective, to make sure that you reflect those facts in your documentation, in your master file and your local file, and think about it now. Don't think about it in 3 years' time. And I realize that 3 years' time is not in line with Indian regulations, by the way, but think about it now. And also her comment around how would third parties react. All those things I think are very, very important that people do think about, and it's very much fact-driven. So just to emphasize the points I think that came from both Shoban and Karishma, which I thought were excellent points.
Thank you very much. Soban, is there any immediate reaction to this so far?
I would just like to speak on what Karishma said regarding business restructuring. Very sensitive issue. But if I go back to case study, so till the time the Italian employees go back temporarily and still do the DEMPI functions for India, I don't see any issues around business restructuring. But the moment we say that they permanently move to the Italian company, so there is a situation where the DEMPI functions actually shift from India to Italy. In that context, there could be a case for some kind of a business restructuring conclusion being drawn, and also chances of an exit charge coming into the picture. Thanks.
Thank you. I think we have many questions coming from the participants. Mukesh, do you want to follow up with these questions?
I think there are some interesting questions which we can take. Rahul, as he is reacting to your presentation, can also respond. One of the questions is there will be difficulties in searching companies in the benchmarking analysis for fiscal year 2020. I mean 2020 for India. The teacher stated that is it possible to use financial year 2000 comparable financial data to benchmark financial year 2020 result, and what is your opinion? I don't know if anybody wants to react to that, but this is one of the questions that just came in. There is another question that has come in, which is by one of the members of the judiciary. It's an interesting question. I will read out there as well. What would be the impact of subsidized lending rates by banks, which have a component of subsidy from local governments in benchmarking the financial transactions of loans and guarantees? I liked, Rafael, your comment that it's not just about the supply chain of the pizza company that is getting impacted. It's every facet of the business of pizza company that is getting impacted, including the financial transactions. And I guess that this question has a context to the financial transaction as well. So I just wanted to read out these two questions. Any of the panelists may wish to react to it, but let's give an opportunity to Rahul, who's been waiting to also make a point to Rafael's presentation. Rahul, over to you.
Thanks, Mukesh. I think I can take the question towards the end because I do have a particular slide to address this particular question. So if it is okay, then can I start my slides, which will be more.
Please go ahead.
It'll be more of a tete-a-tete with the panelists. Thank you, Mukesh. And before we start the session, I really wish to thank and express my gratitude to IFA and Mukesh, also to you as a chairman, for inviting me in this panel. I think a lot has already been covered, and Rafael has done a great job, and along with the erudite panelists which we have. I'm going to cover on three basic, or I would say important aspects of the supply chain. One would be the contract service providers, including the contract manufacturers, the distributors, and the entrepreneurial licensees. And towards the end, we're going to talk about the economic analysis, which is a very important aspect, and then also round off with the approach that taxpayers need to have in dealing with the government, be it the APAs, be it the normal tax assessments, etc. For each of the aspects, there will be a very important perspective of the Indian revenue. So I will park my questions on each of these issues around contract service providers, distributors, and licensees towards the end for Mr. Sobhan Kar to address the issues. So to start with, I'm aware that Graham has already talked about, maybe touched upon this particular aspect, but I would just request him maybe to spare 2 minutes again on an important question which need not be restricted to his type of business, which is in the RNC, retail and consumer. It could be spanning across all type of industries. That, Graham, do you see, in having regard to what really happened in the pandemic and the disruption of the supply chain, etc., do you see global MNEs reconsidering the centralized business models which have been, let's say, set up about 25 years back for the efficiencies and also economies of scale, and moving towards more decentralized models going forward?
Again, I think, Rahul, I think it's some will. I think that you will potentially see some more localization of supply chains. I think you may also see more dispersion, localization of management. Now, that's going to depend, company by company, multinational by multinational. I think some will. I think there certainly some multinationals will look at whether their supply chain is, if you like, being set up in almost too efficient a manner, so that when something breaks down, it's a disaster, right? As if you like, you may have seen in certain situations here where people have relied on one location for their supply chain to originate from. So I think there will probably be perhaps some more, for want of a better description, excess capacity in the supply chain of certain companies. From our perspective, I don't see significant change in what we're doing, just because of the nature of our product, being that it's daily use and relatively low unit value. But from a general perspective, I think your question is fair. I think there will be some changes, and obviously that has implications with regard to how people structure their operations from a corporate perspective when their business models modify.
Thank you very much, Graham. So moving to the first type of business operations which we have in India, and I think this is the most common of them. So we have the contract service providers. It could be the IT services, could be the BPOs, the KPOs of the world, and also including the contract and the toll manufacturers. Generally, what we have seen so far is that for these contract service providers, the global or the regional headquarters, they guarantee the utilization of the entire capacity under a full cost plus markup, what we typically call the FMCU model. And that's how in the captive service providers have framed their transfer pricing policies and working on a net margin, transactional net margin basis, and agreeing on a markup. Now, Karishma, I have some questions which are on this particular slide, primarily for you as an advisor, one of the leading advisors in India. But do you see that the headquarters will be able, and Graham, please feel free to step in. Would you feel that the headquarters will be able to continue with the FCMU model, or would this really add to the financial stress at the global level? And so if there is a little bit of a hesitation or reluctance to go ahead with this full cost markup model, then we can come to other variants as to whether they are possible. So first of all, do you think the headquarters will be able to continue, even if they have these contract service providers, but this FCMU model, will they be able to continue going forward?
So, Rahul, my short answer to that would be that it would depend on the industry because, first of all, if the headquarter is in an industry which has got severely impacted because of COVID, like the airline or the hospitality or any of those sectors, and they have service providers in India which are on a captive model, I would definitely think that this would put a lot of financial stress, to continue with a full cost plus model, because you wouldn't typically do this in a third party situation, if you have so much of business stress in terms of not actually having system profits. So I'm restricting my answer to this limited question right now.
Thank you. Graham, your thoughts, please.
Again, I think I'm speculating here. What I would say is that if you think about certain situations, you've got this almost a survivor risk scenario, and you could be in a situation where if you're in a survivor risk scenario, it doesn't seem appropriate for all of the risk, if you like, to sit in one place. So that's obviously not how transfer pricing has been looked at in the past. But there is a question about does low risk mean no risk, or does low risk mean some risk, and what is that risk? So I think that there is the potential in certain circumstances for a change to perhaps reflect more the impacts of risk at a very high level. So not at a contractual level, but to think about the overall sort of world economic risk aspect to it.
Thank you. Now let's come to the aspect of, how do you actually carry out the transfer pricing for these contract service providers? There are two basic aspects in transfer pricing. One, I'm talking about the contract service providers. One is the bearing of the cost. That means who bears the risk of the capacity utilization. And the other aspect is the arm's length markup. Let's not mix up the two, because this is very critical. We shouldn't be mixing up the two, because it's more of a mundane aspect, mundane way of mixing up the two and just getting a smaller markup as a result of that. Markup is a result of what the market is, how the comparables are faring in the market, and not necessarily the risk of the capacity utilization. Because I, for once, is never in favor of taking up the arguments of trying to bifurcate costs between operating costs or let's say extraordinary costs, etc. That may not be the best way of doing transfer pricing. So Karishma, now coming to the aspect of the bearing of cost, because the how you compute the markup in the pandemic, we'll park it towards the end when we talk about the economic analysis. So Karishma, given the fact that yes, an M&E, global M&E need to have a contract service provider or a contract manufacturer, toll manufacturer, etc., and there is a financial stress at the global level, do you see any of these options which I've highlighted So let's say, would you think that there will be the propensity to move towards a hybrid model? That means instead of a full captive service provider, that certain portion of the capacity may be allocated for trying to venture into the market in India. That means the global M&E tells the Indian subsidiary that, look, I can only guarantee this much of the capacity, and for the balance, well, you go and fend for yourself. And saying is not enough. You have to also substantiate that they are actually taking the necessary steps or the efforts of selling in the market. Or let's say you would consider that while it's not really a hybrid model, but then the capacity utilization risk is to a certain extent shared by moving into a standard cost pricing model with, let's say, an acceptable variance limit. That means if the variance between the actual and the budgeted financials are within more or less acceptable tolerance limit, then you don't make an adjustment. And then you have some sort of a term test over a period of time, and we'll talk about the APAs going forward. So, Karishma, can you just enlighten us on these options and the models which you would like to see so far as the bearing of the cost or the risk of the capacity utilization?
Right. Rahul, first of all, I just like to little bit discuss about the risk aspect, for a contract service provider, because that will become very critical when you move on to actually deciding whether one of these models will work or not work. So, in the real world also, and I think this is one, kind of perception or framework that we have as transfer pricing concepts that we have coined, that a captive company does not take any risk. Now, that is really not true, because, you also have in the third-party world contract service providers like contract R&D companies, contract manufacturers, and captive service providers who do take some limited risk. So first of all, I think, we need to appreciate that the captives may be insulated from an upside or a downside, right, in the overall impact of the business. So that's a different risk. But they do take some inherent risk. Now, and this, it's not only in today's situation, but if you look at from a jurisprudence perspective, even in India, we have a couple of cases which have allowed adjustments of capacity adjustments for captive service providers. Like, you have the CRM case, you have the Transwitch case, and then you have the Petro-Araldite case. So these are some of the cases that talk about the concepts of capacity utilization adjustment. So in principle, I would think that, again, as a transfer pricing practitioner, what I would do is place my taxpayer in what they would have done in a third-party situation. That's the best way to deal with it. And in a third-party situation, if there is financial stress on the global company, as you said, and as we discussed, you would go and renegotiate, on, whether you need to pay the full cost and you rightly said, Rahul, that these are two separate aspects. So one is the cost aspect and the other is the margin aspect, and these two should not be mixed. So just because you agree to a reduced margin doesn't mean that you've renegotiated the contract like the way you would have done it with a third party. Now, some of the other aspects which are also critical is, and if you're talking from a legal perspective, you also have the Contract Act, you have Section 54, which talks about, reciprocal promise. And, if a service provider has not really rendered service because of a situation, would another third party agree to pay such a service provider and insulate him and, give him full cost? So again, over there, I would say that it depends on how you have gone with your third parties. So let's say if you have gone and renegotiated contracts with your end contracts, and you've kind of renegotiated to say that I won't pay you an X amount, but I'll pay you a Y amount, an X minus some amount, you've gone and cut your your salary cost for all your employees, say by 20% globally. These are some of the data points that you as a business have carried out in real situations. This evidently proves that even between the headquarter and the service provider, you will have a negotiation. So the headquarter will have all the right to say that, I won't be able to fully guarantee you, the capacity. In this kind of an economic situation, as you said, one of the options would be rightly to venture out into the local market and then also go ahead and prove that you've actually done that. So that can be a good option. And the second option also that you've laid out in terms of standard costing is also a very interesting aspect, Rahul. And I would say that, this is what you would do in a third party situation.
Right.
So my answer to it is that yes, you will have these options available, and it will all be dependent on your facts of how much financial stress your headquarter has, and also you'll have to be willing to share all these details transparently with the tax authority so that they are able to appreciate that you're not just trying to use the circumstance to reduce the profit allocation to India. But in the true sense, there is a financial stress and there is a business impact on the headquarters.
Thank you very much, Karishma. So moving on to the next type of taxpayers, which are distributors. Again, maybe as a matter of convenience, we have seen that generally the MNEs have classified distributors irrespective of their caste and creed, that means irrespective of their FAR profile or the intensity of functions, as limited risk distributors and assured net margins. Maybe that's convenient, maybe that's easier way of maybe obtaining a resolution in the APAs or MAPs or even for tax disputes, etc. Now, again, in this downturn, and after I just frame my questions, I'll request the inputs of both Karishma and Graham, and reminding myself that the inputs from the Indian Revenue, Mr. Sobhankar, I'll just park towards the end. Again, here the headquarters may be now challenged to remunerate the distributors with fixed net margins due to the economic downturn. Here again, there'll be two major issues. One is who bears the market risk, because in a guaranteed net margin, the market risk is always borne by the foreign headquarter, which is the manufacturer. And the arm's length net profit, the arm's length profit is a different aspect altogether. We'll discuss it later on. So here, would you again, witness or presume there could be some possible changes in the business model? That means people moving to more of a gross margin model. The typical tendency I've seen that people move to gross margin only if distributors make a loss. Otherwise, they're happy making a net margin. But I'm not saying that, gross margin is really it's an escape route from an assured net margin model. But whether, having regard to the sharing of risk, do you think moving to a gross margin model would be more effective in this scenario with a term test to be applied? And then, we have seen a lot of litigation around marketing intangibles, etc., on AMP marketing intangibles. Would you say that in this scenario, maybe it will be better off, if at all, of course, there is a marketing intangible. I mean, you just don't take a resort to a marketing intangible for the sake of it. If there is, let's say, issues of a marketing intangible, then whether you actually take recourse to it and have the benefit of sharing or splitting the system profit, or even could be a system loss between the principal and the distributor. So grateful if you would just, with both you and Karishma and you and Graham, touch upon these options which you have for gross margin, term test, and the possibility of moving to a residual profit split method. Karishma, you can start, and then Graham can chip in, please.
Right. Thanks, Rahul. So for the distributors, again, my view is that gross margin is, even not forget about the COVID situation, but even non-COVID, I would think gross margin is always a better test for benchmarking a distributor function. And in a COVID situation, for sure, because net profit margins get impacted because of various other economic circumstances and not necessarily linked to the transfer pricing between the two related parties. So if one was to, purely focus on the transfer pricing aspect, then I would think that a gross profit margin model would bring you closer to test the reality in terms of testing transfer prices are at arm's length or not. And this is also, Rahul, and you've written about it, and I've read your paper on Tax Sutra about this, and you've written about it very well to say that this is also how third parties actually do their pricing in the open world. So it's always a market-back approach. What you call as a resale minus approach, right? Where you would kind of agree on a gross profit margin. And then operate on that basis, and assuming that beyond a certain period, as you called it, the term test, the company in India is not able to make that profit, then you may renegotiate the gross margin. So I think that's a very practical way of dealing with the situation. Now, the other option I would like to touch upon is that if the revenue wants to focus on the net margin, then I think they need to be open about taking loss-making comparables in the benchmarking, because then you can't have a situation in today's economic circumstances where you expect that a distributor again will be insulated of all the market risks and be able to earn profits on a continuous basis. So I feel that by accepting loss-making comparables, in the distribution set, if you were to focus on net margin, then that is something that needs to be looked at. And one of the other aspects is also, I would say, we need to be a little careful about when we are doing our transfer pricing from an income tax perspective. We also need to kind of align ourselves to the customs aspects. Because for import of goods or in certain industries, you actually also have some customs database available, and I think therefore as a transfer pricing practitioner, you will also have to look at all this public data available and then kind of come to some conclusion. But Rahul, sorry, one more last point is that, again, I don't know whether, in today's situation, we can go by one most appropriate method. That's another point I want to make. I think as practitioners, we need to be open to trying or testing these transactions through corroborative methods. And if the answer to that through different methods demonstrates that there's nothing wrong to do with the transfer pricing, but it's because of other economic circumstances that there is a loss, then that's where you will get your answer.
Sure. Thank you, Karishma. Graham, would you like to add some points here?
Yeah, I would. And I think you could talk for a long time on this subject as well. I will try to be brief. I think what you have to consider from an M&E perspective, first of all, is you think about the theoretical aspects versus the practical aspects. You need to think about that you're potentially dealing with many markets. Now, can you go to gross margin in different markets? How are you going to deal with that? I think, to me, is a very practical challenge that I think from an M&E perspective, I would find quite difficult to do. I mean, frankly, just to go back on the contract service provider, similarly with regard to the standard cost point, I think, again, that sounds a great idea, but the question is, how do you prove your standard costs to the satisfaction of a tax authority? I could see that would be pretty challenging to do so. Coming back to the distributor, the key points for me is, if I think about gross margin, I think what needs to be very clear is the DMP aspects. Who has control of what costs? I mean, if I'm thinking about a distributor in many markets, they could be spending amounts on AMP, but do they actually control that AMP? That's going to depend on the facts of the situation. They don't control that AMP, which certainly in many of our situations where we operate through a regional leadership, I think that the ability to do gross would really be very, very difficult, because in essence, what does the distributor control? It controls its overheads, but it really doesn't control its the AMP spending. So I think you need to look at the characterization of the entity and look at what it controls from a DEMPI perspective. And I think the last point, which I think has been touched on, is, is there something here to be thought about as we think about amount B in the future? Is there something to be thought about with regard to the relationship between distributor returns and system profit? Is that something that could be brought back into the equation to be thought about as we think about where we may from a going forward perspective?
Thank you very much, Brian. The next one is on the entrepreneur licensed manufacturers. I want to deal with the issue of royalty. That again, in the challenging times where the licensees could be faced with financial stringencies to pay fixed rate of royalties, whether it's really the time to move into the profit-linked variable royalty models under a profit split method. Rafael did touch upon it in his slide, so I'll park the discussion on this particular slide as we move to the revenues comments towards the end. Now I'm moving forward to the economic analysis, a very important aspect, markups, the return on sales, gross margin, whatever it is. We talked about the business models, and now we are talking about culmination of the business models in terms of finding the economic analysis and finding the arms and price. And here I would request the intervention of Mr. Sovankar, that you see from an Indian transfer pricing regulation standpoint, today it's mandatory. Earlier, before 2014, we were talking about the single year data. Then the Indian government moved towards the weighted average of financial data for the last 3 fiscal years. So let's say for the COVID struck fiscal year of 2021, the ALP as per the Indian regulations are to be determined by considering the weighted average data for the last 3 fiscal years, 18, 19, 19, 20, and 2021. Now, so far as the taxpayer is concerned, he has suffered the downturn perhaps in 2021. But when you go and compare it with the comparables, now the comparables are having the average of 2 good years and 1 bad year. So how do you really see, sir, do you think that the government will need to come out and make some changes to the regulations? That means either have the weighted average data for 3 years, both for the comparables and also for the taxpayer like we have in US, or have a dispensation for the COVID struck years to say that you can only use a single year data. So, sir, grateful for your views on this.
Rahul, I will start on a lighter note. For many years when we were stressing on a single year data, we were pilloried by everyone that why don't you have a 3-year average going forward? Now, the anxiety writ large on taxpayers' faces, but that's just on a lighter note. I do appreciate that the kind of crisis that year 2021 is going to be, a 3-year weighted average may not capture the downturn or the business hit that they have taken. But at this point, I'm really not in a position to say whether government would switch over to a single year comparable data for this crisis, or as you suggested, can we then balance out by taking 3 years data for both comparables and the tested party? So this would be an issue which would be debated, and we would like to hear from taxpayers, because as I said earlier in my intervention, the impact on taxpayers is going to be extremely asymmetric. So again, there cannot be a single approach for all taxpayers. If it is warranted that only single year data be taken into account, then maybe the government could give a consideration to it. But as per existing law, there's no provision for a single year data unless we do not find enough comparables to come up with meaningful results.
And so we can probably have some economic adjustments for the data for 18, 19, and 19, 20, assuming that we are talking about 2021 as the year for under analysis, by taking cue from maybe drop in sales or whatever it is. And there could be several innovative ideas which we obviously cannot discuss in such a short time, that perhaps some sort of an economic adjustment may need to be brought out for fiscal years 18, 19, and 19, 20 to effectuate the downturn. So, sir, moving on from this aspect into resolution of APAs, into the manner in which audits can happen, and we are all aware of the stringencies of the time that we have in this session. Probably it could have gone on for hours. So, as one of the pioneers for the APA, how do you see these aspects which are there on the slides? That means for the resolved and the signed APAs, is there a possibility of modifying those APAs based upon the possible change in the business model, and also, let's say, for modification of the ALP for the years which are likely to be struck by the COVID?
Rahul, as you have personally experienced, the Indian APA program has adopted the taxpayers' interests while discussing cases with them. We have been extremely flexible on various issues. So for completed APAs, we are willing to listen to the taxpayer and what kind of impact the COVID-19 is having on their business. So as you know, that revision of APAs is very much possible. Taxpayers can approach the APA authorities with documented evidence of the kind of impact they have faced. So there could be a number of outcomes. You know, one could have a separate ALP for 21 if it is warranted and if it is backed by evidence. There could be even, there are many APAs where 2021 is the last year of the APA. One option I see which could be attractive for some taxpayers could be that they can terminate the APA at the end of the 4th year, and then when they come for a renewal, we would have enough economic data with us to analyze that year in isolation. Today it is not possible. So revision might take time. The third option could be, there are many taxpayers who have spoken to me recently who either have a completed APA or who are negotiating a fresh APA with us. They have categorically said, especially those who are captive service providers, they have categorically told us that the impact on them is minimal. So again, it goes back to that asymmetric impact of COVID-19. Now, if the impact is minimal, I don't see any problem in continuing with the existing APA or negotiating a fresh APA with whatever data points taxpayer provides to us. So we are flexible. We are willing to look at all the completed APAs if the taxpayers want us to look at those. And for future APAs, we are specifically asking taxpayers to tell us, I mean, it is too early, but they have an opportunity to tell us what kind of impact they have faced due to COVID, and that would be taken into account while negotiating and finalizing the future APAs also.
Thank you, sir. So now let me come to the last question, again on the manner in which the APAs could be resolved. But the question is common for contract service providers, distributors, licensed manufacturers working on a royalty, etc. So we have discussed about the sharing of the risk. So let us say a contract service provider moves to a standard costing model. A distributor moves to a gross profit-based remuneration. A licensed manufacturer moves towards a profit-linked variable royalty, where there is an ex ante and an ex post. That means, we go with a budgeted, approach of gross margins or a standard costing, or even for the RPSM, and there is the actual financials which crystallizes at the end of the period, whatever it is. So how comfortable do you think the revenue would be? So we have seen you as probably one of the most pragmatic and progressive of the APA commissioners and the officers, sir. How comfortable do you think that the revenue would be to move into these sort of term tests with the standard costings or the gross margin based models ex ante and ex post? This is the last question which I have, sir, and then I'll pass it on to our chairman, Mukesh.
Rahul, term test is something that we are still not very comfortable with, primarily not because of the economic rationale behind it, primarily because of the kind of system we have in India, where income is to be computed on a yearly basis. So testing of arm's length principle has to be done on an annual basis. I have no economic problem with a term test, but it is more of the legal and administrative aspects surrounding it. So far, we have not blessed a term test in any of our APAs, and I really don't know that in the immediate future if there could be a possible change in our stance. That looks a bit difficult.
Maybe, sir, bilaterals could be providing a little more latitude and a little more flexibility as compared to unilateral. I'd leave it to your good hands, sir.
I mean, I can envisage a situation where the COVID year can have a ALP which is markedly different from the other years. That is possible, more so in a bilateral scenario. But I still feel that term test would be something a bit difficult. Yeah.
We'll all work towards that resolution, sir.
Rahul, I just have a point to make to Shobhankar sir. Sir, you said term test is difficult, but I mean, I would just suggest if you can look at that under a broad other method, because generally the other method under the Indian provision allows you to do anything which is what you would have done in a third party situation, So, I mean, this is just a suggestion because I think it will be good to either allow use of 1 year data, give some dispensation, or have something like a term test. Otherwise, yes, the other option, as Rahul said, is economic adjustments, but that is all subjective and would lead to a lot of litigation. So, just wanted to mention that, Rahul.
Yeah, thank you so much. Mukesh, over to you. Thank you very much.
Thank you, Rahul. We can still take some questions, but I was just mindful of Mr. Salve's timing. But I think more importantly, we are waiting for Honorable Dr. Justice Vineet Kothari to summarize the session and share with us his perspectives as a serving judge of the High Court.
I've been listening to all the experts for last about 1 hour, so I joined a little late, and thank you, Mukesh, for giving me this opportunity to be part of this session in a very prestigious conference which you're holding. I've been part of IATJ, as you know, as a board member also and a member, and I have done some study of transfer pricing, though I cannot claim to be an expert of this field. But as we know about this COVID situation, all of us, it has completely disrupted or rather dislocated all the economies very badly. And when it will end is also not known to any one of us. And therefore, I think it is time to put a pause button on this TP adjustments for some time. Because, businesses have suffered, economy has suffered. And the whole TP adjustment exercise depends upon the availability of the comparable data of the other comparable cases, whether you take 3 years average or 1 year's average or whatever. But the comparable data also have gone haywire for this 3-4 months period, which will be part of this 2020. And as in the lighter vein, people say that 2020 should be erased and then reset button. So likewise, I feel the TP adjustments exercise needs a pause button for the time. And because, more thousands of factors affects this exercise. And all these adjustments are open to disputes being risen and dispute resolution required. And as far as our country, India, is concerned, I think dispute resolution takes pretty long because it doesn't settle at the level of tax gatherers or departmental level. It reaches up to constitutional courts like one of the high courts which I am part of, and up to Supreme Court also sometimes. And therefore, the uncertainty which prevails in the process makes the very exercise of TP adjustment on a cost-benefit analysis scale, if we measure, little more dear. So what I feel is that or bodies like OECD or CBDT of our government have to come out with some broad guidelines about the TP adjustments which should be made in when the business resettles after the COVID curves flattens, and after giving some time, because then only you can have really the reliable data of comparables to make go for the TP adjustments. I was hearing Mr. Sovan Kar, I believe he's from the government side. So with some authority also and some sense of great responsibility also, he was saying that government is very flexible to listen to the voice of the taxpayers, and they are open to all good ideas about this whole exercise of TP adjustments. And that's very good of the government, because the impact of COVID on the various businesses and the factors which are to be taken into account for making this whole exercise is asymmetric. Since the factors are affected asymmetrically, therefore the whole exercise of TP adjustment is open to new ideas, new things, new factors, like business lending rates, bank rates change. All these things, various hundreds and thousands of factors, the experts have already enumerated many of these factors in their wonderful speeches which they have just rendered. But finally, the whole exercise is comes to the dispute resolution. And therefore, I feel, since it's a little lengthy exercise, the whole exercise should be taken with a kind of broad and uniform guideline from the side of the authorities. And the government and the bodies like OECD have a big role to play in all this exercise. The webinars like this which you are organizing, and IFA Chapter India and all IFA International, they have a big job to do. They can give the inputs to these authorities who can develop such kind of guidelines in these times. So I will not go into the details of the various business models and economic analysis and things which have been just discussed, because if there are some questions on them, there are experts on the panel to answer all that. But what I feel is that post-COVID era transfer pricing regime has to face many challenges, and various factors will have to be analyzed. They will have to be taken into account by the tax gatherers, and taxpayers' difficulties will also be abound. Therefore, we all have to apply our mind, try to develop some kind of guidelines for the taxpayers, so that the whole exercise of TP adjustment, as you know, is in a matter of estimation, I would say. Because there you cannot precisely say that this will set off the correct, reflect the correct and real income of taxpayer for the particular year. So this whole estimation exercises has to be done in a very fair and equitable manner. Though it is said there is no equity in taxation, but in equity and fairness in the administration of taxation is definitely required. And for that only, I think we sitting in courts and tax gatherers sitting in the revenue departments and taxpayers in their respective business houses have to give their inputs together and then develop a kind of, as far as possible, agreeable models for these TP adjustments. The best, I think, would be to go back to the previous year's data of the same taxpayer if they are available, and then adopt the same model. And then if that is not possible, to give suitable margins or discounts or factoring in the variations, which itself will be a subject matter of debate and discussion between the taxpayers and tax gatherers, which has to be undertaken by the departmental authorities. This is my viewpoint about the whole concept of TP adjustments and exercise to be done in various countries, and depending on the treaty obligations also, the various things have to be taken into account. Thank you. Over to Mukesh.
Thank you, Honorable Justice Kothari. Your pearls of wisdom are valuable. My take was the last bit that you mentioned, that whilst administrations and courts are reflecting on taxpayer disputes, equally important is the treaty obligation, which incidentally, Honorable Justice Kothari also happened to be the theme of this 4 series webinars that we ran. Equally important was my takeaway from my friend Mr. Soban Kar from the Ministry of Finance, that he made some very important points. He said we are willing to relook, we are sensitive to taxpayer situations, and we understand taxpayer situations. But he also added a very important point, which is that taxpayers will have to cooperate and documentation, which is a point that Dr. Rafael Petrosi started off with when he talked about the cooperative federalism concept in the tax regime of many of the EU nations. So this is extremely useful. Well, Mr. Salve, Queen's Counsel, Blackstone Chambers, Senior Advocate, Supreme Court of India. It's not easy to introduce him, but nevertheless, I'll make an attempt. 10 years back, when I became a member of the Supreme Court Bar Association, the story around the corners of Supreme Court was, when other councils stop thinking, that is where Mr. Salve starts thinking. Well, as a go-to counsel for almost all arms of law, civil and criminal, Today, Mr. Salve would be talking about his first love, which is tax laws. It is a tax law which drew chartered accountant Mr. Salve to the bar. In 1975, when Mr. Salve prepared a note on some of the interpretational aspects of the Income Tax Act 1961, India's leading jurist, late Mr. Palkhiwala, asked, "When are you joining the profession?" And in his own words, he says the die was cast that day. For a career that has spanned over 4 decades, it is not possible to list out even important accomplishments. I'd just like to mention some special aspects. His contribution to the Kulbhushan Jadhav case at the International Court of Justice, and besides the other important landmark cases, be it the Vodafone or the 9-judge entry tax case, where he led the arguments for the taxpayer. That was the last, at least I saw him in substantive arguments in the Supreme Court on a very important case. Some of the old cases which we forget, or probably we looked at it as a student of tax law, I would like to mention that the United Commercial Bank case, where he persuaded the Supreme Court to reverse its earlier ruling in the State Bank of Travancore case, which was per incurrum. Then the famous Podar Cements case in the Supreme Court, where he established that an owner was not necessarily only a person in whose favor the sale deed is registered. He also was famous for his first Azadi Bachao Andolan case in his capacity as handling, or rather rising to fame in the international tax arena, and thereafter the GE Technology case of 2010 and the Ishikawa Harima Heavy Industries case, which incidentally was also the first case which traveled from the AAR to the Supreme Court of India. As one of the youngest Solicitor General of India, an office that he assumed at the age of 42, Mr. Salve conducted a large number of important matters, the first being the anti-dumping case, where he argued in the Supreme Court, and the first case of privatization of public sector undertakings, also popularly called the Balco case. He was also involved in crucial non-litigation work, such as conducting the WTO negotiation, drafting the electricity reforms, and setting up legislation for Competition Commission. Mr. Salve has represented all major corporate houses, which is what he's talked about. But I'm not going to talk about that because we all know it. Most people also do not recognize the role that he has played as amicus appointed by the Supreme Court on a host of matters, including something which is very close to his heart, the environmental matters, wherein he took on major large corporates and multinationals in the illegal mining cases, pertaining also to his contribution in the diesel cars case to save the city of Delhi. The spectrum of cases that he has appeared is indeed very vast, but the commonality in all his cases is his own words, that he breeds his matters and has always presented complex legal propositions with clarity and simplicity. Whenever I had an opportunity to brief him on tax matters, the same clarity and simplicity never ceases to surprise me, especially when an interpretational conundrum arises and he still refers to his 1977 edition of Kanga and Palkhiwala on the Treaties and Income Tax Act, which has been hand-signed by Mr. Palkhiwala, and also bears, more importantly, Mr. Salve's annotations when he first read the book. He did so very clearly when we were preparing for the Shell and Vodafone cases, when in the middle he remarked, "Please get my 1977 edition of Palkhiwala." So with that, let me hand it over to Mr. Salve for his address. Welcome, sir.
Like a large number of your arguments, there have been exaggerations. You paid me compliments which perhaps I hardly deserve. But yes, you have reminded me of how many years I have been around. 4 decades, as you say. This June makes it 4 decades. And it's when I went through the brochure you forwarded to me, the e-brochure of the subjects which you were discussing, and you spoke as you closed off my 1977 edition of Balkiwala. I don't think any of these topics are to be found in the 1977 edition. That gives you a sense of how far and in what direction the tax law has grown. It is a tribute to India and the Indian economy that we have globalized to an extent. Today we are discussing problems about the abuse prevention in international tax law. We are discussing problems of digitization. We are discussing problems of domestic law meanings and undefined treaty terms. And we are discussing transfer pricing, which has become today as common a dispute as in our days used to be the dispute about the GP rate in a trader's profit and loss account. And this, to quite an extent, is a tribute to the globalization of the Indian economy, to the coming together of different countries and of a rising above sense of sovereignty in the area of taxation. And I'm starting with this because of late in the COVID lockdown, I have been making certain radical suggestions, and I'm going to make a radical suggestion today. If you look around you, the world is a very different place today. And yet at the same time, it is not that different a place. If you read about the opium wars of the early 19th century between China and Britain, China on one side and Britain and France on the other side, two broad issues were involved: the right to carry on trade in various parts of China and reasonable tariffs. If you look at tax, not just limited to direct tax, but if you look at tax as a fiscal measure, the confluence of direct tax and indirect tax is how countries not only raise revenues, but create boundaries by which they favor domestic industry or they keep out foreign businesses, foreign industries from entering their shores. And the problem is as old as the 18th century, if not earlier. 18th century, because by the time global trade had picked up significantly enough to warrant a war, well, you had the war. But if you look around you also, the model of big business, and when you're discussing these issues of tax, you're not talking of small and medium-sized enterprises. We're dealing with large businesses and large assessees. The model of doing large business has changed dramatically. And I have been fascinated in the last 5 or 7 years to see how the world has changed from feudalism when I was a youngster to the newerish promoters and a new kind of feudalism, as it was called, which rich promoters with large corporate entities, and therefore concentration of economic power in a handful of hands, to the present model of multinational companies who are owned by nobody. Private equity funds, funds managers, to a large extent source domestic savings to invest in companies. And the returns which they get goes back to the average investor. I was doing a case the other day, which is very interesting in the COVID context, about the moratoriums being granted. And a very interesting dimension emerged in the course of my discussions. You have the common man on one side who buys a flat and who has lost his source of livelihood because of the lockdown. He cannot pay the NBFC. The NBFC cannot then pay the non-convertible debenture holder, the mutual fund. And the mutual fund cannot pay the common man who is invested in the mutual fund. On both ends of the spectrum, you have the common man. And you have these large so-called massive financial giant intermediaries, all in the middle between the two common men. And that is what is today going on. You have the common man who buys mutual funds, the middle class who buys mutual funds, who invests in companies, which companies do business. And interestingly, but unsurprisingly, the business model of all PE managers, whom you know better than I do, is to find the best possible return. So you are today back in the heart, in one sense, in the hardest form of capitalism, that capital will find the most paying resource. And on the other hand, you are in a situation where there is no promoter whom you can demonize. Now, in this world in which we find ourselves, and I must tell you, if you must have followed with interest, all of you must have followed with interest what's happening to India's largest company and the number of institutional investors. And I call Aramco an institutional investor. I call these large PEs institutional investors. Mubadala is an institutional investor. When all institutional investors coming in, with all institutional investors coming in, one of India's largest promoter-driven companies is going to become institutionalized. And Mr. Ambani says the 21st century definitely is for institutionalized corporate enterprise. If this is the new model of doing business, and it's increasingly drifting in this direction, and when I say business, I mean, of course, large business, this is going to be one new normal. We have a phrase which has today become the current coin, which is called the new normal. COVID has forced us to all of us to sit down and see where we are, look back at the road traveled and focus on the road ahead. And a lot of things are going to be re-engineered. One of the things, the value of which is being seen now is the digital economy. In a lockdown, the only thing which has kept the world afloat is the digital world. Online deliveries, online food, online groceries, online, and whatever commerce is going on is online. Digital economy is the biggest savior in today's COVID age. So digital economy is the new normal. If digital economy is the new normal, and as states increasingly compete in this new world for their fair share of revenues, we need to first redefine certain paradigms by which taxation law across the world has to be imposed. The old notion of doing business, earning money, and paying tax to a sovereign is today antiquated. And both the taxpayer and the tax gatherer need to come to terms with this new normal. Today, with global businesses, a company incorporated in America with an office in Cayman Islands is supplying goods from Luxembourg with an IP address maybe of Netherlands to a person sitting in UK who's transshipping them to India. And all happening on the click of a mouse. Funds moving from account to account across jurisdictions, across countries in nanoseconds, all on the click of a mouse. I've shown one thing, that where it comes to the relationship between the large business and the government, there has to now be a partnership. And that partnership, which Mr. Palkhiwala spoke of in those days, is today an absolute necessity. And this partnership on the one side must have the taxpayer, the big taxpayer. And on the other side, it must have all the countries sitting together. We have to now realize that when it comes to large commerce, large industry, and the bulk of the tax revenues for developmental activities, for social welfare, for running a welfare state, even in India. If you see the Indian budget, the bulk of the revenues come from large taxpayers. And the biggest jobs are provided by the large taxpayers. So if this is going to be the new model and large taxpayers are going to have a global footprint. If this is so, then the whole notion of every country saying, oh, I will be the master and I will be the sovereign and I will dictate my terms to a taxpayer has long gone. Grudgingly and gradually, countries are coming to terms with this new normal. What are the signs which we are seeing and which, according to me, this is a good moment to remedy? The signs are we are in a state of tax wars once again. The 2016 US Department of Treasury paper makes fantastic reading. Look at what happened. Large companies like Apple, Starbucks, Fiat, Amazon, all found, even in countries like Luxembourg, countries like Netherlands, countries like Ireland. The first reaction came from the European Union, where other countries like United Kingdom, like Germany, like France, objected to this and said this is a favorable tax treatment. That went to the European Commission, then the General Court's decision has come, which is, quite frankly, rather unsatisfactory, and it has to be unsatisfactory because a large part of it is procedural and a large part of it is on certain substantive issues. But one very important thing which the General Court has recognized is the power of the European Commission to regulate tax laws of different countries, to see whether they're giving unfair benefits. And the counterpoint came from the United States, because these are all American companies. And the US Department of Treasury raised this issue of taxes being treated as measures of state aid. And they raised the objection. Now, this is very interesting. They said the European Commission is departing from the OECD transfer pricing guidelines. It is departing from the classical tests of what is a state aid. What is the test of economic benefit granted in a selective way? And the US government is actually arguing exactly what the companies have argued, what those favoring countries have argued. And the most important thing which they have raised, which according to me, if you step back from the role of a lawyer and see it more from inter-country relationship, they said you are now going to raise taxes and lay these taxes on a retrospective basis. And all these taxes are liable to double tax credit under the tax treaties we have. And ultimately, American tax will be affected. This is the heart of the matter. All countries today are sharing the pie. Global tax by enterprises in global trade is growing. This will continue to grow as digitalization. Digitalization has been accepted today whatever may be its difficulties in regulation, whatever may be its difficulties in taxation, the public good coming out of digitalization is so overwhelming that digitalization is going to be the way. If digitalization is going to be the way, it's been a delightful exercise reading the papers which you so kindly put up on your website about the learning on the tax challenges of the digitalization of the economy. But what I take back from that, and as you rightly flagged right in the beginning, my knowledge of tax law is Palkhiwala 77 edition. But what I take back from all that is there are no answers. There are no answers. Look at India's stab at digitalization, the equalization levy. Is it constitutional? I think is the least important question. Perhaps it is. But the more important question is it sensible? Is it feasible? Anybody using an Indian IP to buy something must pay tax. A person like me who travels and I'm visiting India for I discussed this with you offline, and a person with your genius didn't have the answer to this. I don't know how many people will be able to answer it. Mukesh Butani doesn't know the answer. I don't know who does. If sitting in Delhi, I log on to the Selfridges website and order something for my London home and I go back to London, but the IP which I use is Indian because I'm using my Delhi office IP. Who pays tax in India? And more importantly, how do you collect this tax? I remember we are back to the mid 70s, where, if you remember, the first slew of amendments were made to Section 9 to tax royalties. Those days, India was big in importing technology. And taxation of income from royalties on technical services, taxation of the salaries and allowances paid to foreign technicians was the main area of international tax law concern. And at that time, I remember Mr. Palkhiwala wrote an article saying, if this goes this way, and it continues, this appetite of the Indian Parliament continues to grow to impose tax, we will reach a point where if an Indian walks into the Harrods and buys a shirt, you will expect Harrods to pay tax in India. And that is where we have reached. If an Indian buys a shirt from Harrods and an Indian IP is used, you must pay tax in India. All Harrods does is hand over that package to DHL, who delivers it in Delhi or Bombay or whichever part of India it has been ordered from. So I think we need to sit back and think, and I've read a lot of material on this equalization levy written by a lot of Indian top tax experts, searching in vain for an answer as to who is going to collect this tax and how. And I don't think anybody has an answer. So I think the more important question you should be asking is this tax feasible? But why has India imposed this tax? And in one of the papers written by one of the law firms, I found something which had great resonance. It said, frustrated with the speed of BEPS 1, countries like India are now reaching out to impose unilateral taxes. You know, as you have seen, the US has started a trade inquiry into whether this tax is targeting American companies. Unless we resolve these issues and find a paradigm by which these issues can be resolved, you will have increasing dissonance between countries. I don't think you can come up with a legal principle of sufficient clarity and certainty on which digital transactions like this can be taxed. You will have to have some rules by which countries sit together and decide how they are going to share the pie, and to which big digital companies must agree. They will not go running to the next Ireland. They will not go running to the next Luxembourg. They will not go running to the next Netherlands, but they will comply with those rules and distribute the tax accordingly. Taxation systems are under stress. The first day of discussing abuse prevention in international tax law. And you had the Indian and Mauritius perspective. Doesn't it, in one sense, dial back to the same issue? What did India do with Mauritius? Yes, you mentioned I argued the first Mauritius treaty case. The Delhi High Court struck it down. Supreme Court upheld it. As Solicitor General of India in the Delhi High Court, and then appearing for the funds in the Supreme Court, what were my instructions? There is a large Indian diaspora in Mauritius. And that is one of the geopolitical compulsions. Why in the Pacific Rim, we want to have a special relationship with Mauritius. Those were Government of India instructions. They were put on affidavit. You can find it in the record of the case. Would you, in one sense, call it giving a favorable treatment to a sister country? But it was. Let's apply, if you step back, let's apply the philosophy underlying GAR to Mauritius. Mauritius did not have capital gains tax. And Mauritius had this law of overseas business corporations, which by definition would not do business in Mauritius. There were foreign companies which would set up an office in Mauritius to do business outside Mauritius. So the intention of that company was not to do business in Mauritius. And Mauritius had no capital gains tax. The intention of those companies was to buy shares in other countries. And in a treaty which says capital gains will be taxed in Mauritius, what are you doing? You are virtually saying, to this extent, India agrees that its capital gains revenue will go to Mauritius. Now, one way of looking at it is, and it did, and I must confess, these kind of treaties do create distortions. And then when you come with GAR, your arguments, your philosophical arguments sound unconvincing. Look at the facts of the Vodafone case. Repeatedly, what I argued, and why is it that the judges finally accepted that there was no mischief involved? Repeatedly, I argued that the last tier of companies in the Vodafone structure was Mauritius. If those company shares had been sold by Hutchison to Vodafone, there would have been no dispute with the tax department. Just because they sold an upstream company, the dispute arose. And the tax department's only reply was, but you didn't sell the Mauritius shares. That's all right, that's a technical answer. But on the philosophy of tax, is that an answer to GAR? That if you had sold the shares held by the Mauritius companies, directly shares held in Indian companies by Mauritius companies, you were right, there was no tax involved. And there was no immorality involved. But if you sold an upstream company, there was immorality. So this treaty, GAR, these are all, none of them today are a cohesive scheme. And why is this going on? I'm not blaming India. The problem is treaties are negotiated between countries and tax laws and treaties follow different paths. But the treaties are country to country. And today in the digital world, where it is going to be multiple countries involved, how do you share jurisdiction? As we all know, tax treaties, as we say, are treaties for dividing jurisdiction. How will we share jurisdiction? Well, 5 countries are involved unless you have a comprehensive global tax treaty. The reason why I say we have to move with alacrity and to deal with this is, please see where we are going to find ourselves very shortly. The COVID figures on the economy have recently come out. Where UK is concerned, there is so much concern because they say UK has experienced the sharpest economic contraction since the peak of the financial crisis. Here, the Q4 of 2008 is considered the beginning of financial crisis, after which things slowed down. And then things were picking up. GDP, they say, will fall even more in Q2 as the lockdown continues. 2 million claims, and this is very important for what I'm going to say. 2 million new claims for benefits have been made since mid-March. And this is despite the government job retention scheme of furloughs. 2,000 claims a day. Compare this to the peak of the financial crisis, which was 7,000 claims a day. Today is 100,000 claims a day is what it has reached today. 7.5 million jobs are covered by the furlough scheme. The government is picking up the tab, as you know. £2,500 a month is being paid by the government, multiplied by 7.5 million. Where is this money going to come from? This money comes from tax revenues. But where are the tax revenues going to come? There are no incomes. There are businesses in the city, I know, whose revenue streams are down by 40%, 50%, 60%, 80%. There are 4 very large catering companies which cater to the city, the financial markets and the legal services markets, whose revenues are zero because the city is shut down. Nothing is working. So you can't raise more taxes. The government here has given time up to January 2021, even to all taxpayers to pay their tax. Net public borrowing is almost up to 300 billion, which they say is the highest ever in UK since Second World War. Look at India's figures. India's GDP is estimated to decline by around 9% between April and June. That is why the serious concern of negative growth and contraction of the economy. 1.3 billion people are facing lockdown, as you know, in India. 312 billion rupees have been directly invested by the government of India in medical care and COVID relief. And the total amount under the Pradhan Mantri, the Prime Minister Poor scheme, the Pradhan Mantri Garib Kalyan Yojana, I believe the commitment is 1.7 trillion rupees. It's a lot of money. Government will have to print notes, and it is good. This is the time for deficit financing. Your ducks are all in a row. Interest rates globally are extremely, extremely low. Crude prices are low. This is the time you can print money and not worry too much about inflation. But where is this money ultimately going to come from? And where are the taxes going to come from? So we have two choices, two stark choices: taxation by consensus or taxation by tyranny. We have two straight choices. I've used this phrase before and I use it again. At least in countries like India and everywhere, countries have seen the people for the first time like this after World War II. The prime ministers addressed the countries and said, people, please observe lockdown. Let us not be naive to think that it is the fear of the police or fear of arrest by which people obeyed lockdowns. People obeyed lockdowns because they thought, yes, this is the time where you have to unconditionally support the government measures to fight this pandemic. Let us build on this trust. Let's hit the reset button. Let's get into taxation by consensus. Justice Kothari mentioned no equity in taxation. That's true. No equity in taxation is the rule as we understand it. But let's step back. That is an adage which goes back to the feudal days, where a tax was considered an unfair exaction from your own hard-earned money. Today, the new adage is that there is no equity in tax arrangements, by which countries are denied their fair share of tax. This has to be the new paradigm, which the taxpayers and the competing countries have to accept. fair share of tax. The Duke of Westminster, who spoke of no equity in tax, is now a vestige of a feudal system, in which, like a lot of such vestiges, looks best only on statues of a man on a horse. What we need today is a rethink. Tax dispute resolution has failed. I know we are all tax dispute resolution professionals, but let's step back and accept that tax dispute resolution has failed. And it can never work to serve a digital world. The timelines never work right. And I'm talking of timelines in countries where dispute resolution works fast. US, the United Kingdom. In countries like India, we all have foreign clients who, when they hear of the timelines, ask the next question, is there some way of settling the dispute? The uncertainty of dispute resolution makes it hopeless. How do you advise? If you're making a transnational investment, how do you advise people? And then in countries like India, where we suddenly go through these bursts of sense of nationalism and sovereignty, where Vodafone was in parliament by certain eminent MPs called a black money case. Retrospective taxation. I remember I must take responsibility for at least 3 major investments being diverted from India. I won't name the clients, they came to me. And they said, how do we plan? And I said, the only way you plan is you take your gross revenues and apply the tax rate. And if it still makes money for you, you do business in India with any tax benefits which you get less than 30% applied to your gross revenues being a bonus. But if you are planning that this will be my potential tax liability and you're planning to invest, I think you're making a very high risk investment. Large $1 billion plus investments don't come with degree of uncertainty like this. And the biggest uncertainty is first the uncertainty of fighting it in courts. And now the uncertainty that after winning everything, somebody might just say, oh, let's change the law. So tax dispute resolution for smaller assessees on case-by-case basis, yes. But if you see the bigger problem, the problem of digitalized economy, the problem of abuse prevention, you can have as many guards as you want. 2 regulators will come down on 2 different sides. 2 different courts will come down on 2 different sides. I'm not certain if Vodafone was argued again, another bench of 3 judges would come down to the same conclusion. And I'm not blaming anybody. I'm just saying that's the nature of the animal. So what we need today is to revisit this notion of tax sovereignty. If you know, there was an international arbitration proposal when tax treaties were being worked. And a lot of countries, including India, protested that we can't give up our sovereign right to impose tax. And that is why we had to settle for a much diluted version of the mutual assistance procedure, the MAP procedure. There was on the table one of the proposals saying, especially for complex disputes like transfer pricing, why can't you have a judicial tribunal selected by the 2 countries which will decide the case? Otherwise, the problem is never satisfactorily resolved. So this is something today, the time is right where we need to rethink. This taxation, and countries like India then get down to, oh, but we know how to recover our tax. So our default position, tax by tyranny. This is completely incompatible with the new normal system, completely incompatible with the digital world, which we are going to see increasing. This is completely incompatible with the Prime Minister and India's dream of a 5 trillion economy by the end of the term of this government. It is not going to work. India has the lowest median age In a World Bank report, it was described as India is waiting to reap the demographic dividend. If these youngsters don't get jobs, this will turn into a demographic nightmare. And all countries have now to recognize this one-upmanship is not going to work. It's no use for Ireland to say, I will suck in the apple and give them a beneficial treatment, and the rest of Europe will not get its fair share of tax. It will not work for Netherlands to say, I will get in a Fiat or an Amazon and I'll give them beneficial treatment. I think we need, at a global level, not just a base erosion and a profit sharing, but a partnership project, a global tax partnership project. And this global tax partnership project must have the taxpayer as a partner and countries as partners, and arrive at norms which are worked in the spirit of a partnership, which dispute resolution through international tribunals, so that nobody feels that a sovereign court has decided and sovereign courts are at loggerheads. If we need to reach the dividend of digitalization, this has to be the new normal. It's wonderful that you have had this series, and I see you have covered amazing topics. Some fantastic learning has come. The learning is so good that you forced me to put down my 77 edition of Palkiwala and read through all this. And I must say, I have learned a lot on tax law. Thank you.
Thank you, sir, for an excellent exposition. Just thought I'll clarify that my reference to 1977 Palkiwala edition was just for your love of tax and not meant to your knowledge, at least seeing you and observing you as to how up to date you are on international tax cases. Sir, I wanted a few questions that came in, and I wanted to build in on some of the themes that you spoke about. And I liked the taxation by consensus and taxation by tyranny approach. And I presume that when you talked about taxation by consensus, what you had in your mind is the comment that you made in relation to India's response to equalization levy being an outcome of the failure of the consensus approach. But sir, the consensus also has to be with the taxpayers. There is a growing feeling in India that the manner in which the equalization levy law was legislated, it was not there in the finance bill of February 1. It was pushed in through the amendment a few days after the lockout, and it was passed in the parliament when the country was already in the lockout. So, and in light of that, there are obvious reactions. There are reactions coming from the US Trade Commissioner by way of 301 investigation on the ground that they are discriminatory. So your quick comments on the taxation by consensus principle in terms of stakeholder participation by the taxpayers, particularly the large e-commerce giants, and your comments, if any, on the discriminatory allegation that United States Trade Representative has raised.
It's very important that we shed this mindset that we can do whatever we like, and we are such a big market, the world will fall in line. The equalization levy, hopefully, is the last vestige of this mindset. I hope the change in mindset comes, where a group of people sit together and say, we don't need to consult everybody, because a phrase Mr. Palkiwala was very fond of using, all the wisdom in the world is in the North Block. This mindset has to change. You're right, the manner in which such an important levy was brought without any public discussion or debate is an insult to democracy. It may be constitutionally valid. A constitution doesn't provide that people should be consulted, but good governance does. If you had consulted people, maybe they would have come up with a model which was more feasible. I have, in my other webinar, I had suggested India needs to hit the reset button where it comes to the stakeholder concept. Why can you not have a retired chairman of a real estate company as the head of the regulator of real estate? Why can you not have a retired chairman of a finance company as the head of your economic regulator? Why not have industry representatives in regulation? Why does it all have to be retired civil servants and retired judges? This is a mind reset we need. And once we have that mind reset of consultation, of discussion, of consensus, you will not have measures like this. And I'm not saying whether it's lawful or unlawful. I read the American complaint. It says it is discriminatory. Well, facially, it doesn't appear to be discriminatory because it applies to almost to every business worth its size, because the figure is so small, the threshold is so small that it'll apply to every significant business. And it'll apply to every significant business from anywhere and everywhere. But we are back to where we began. I remember having this discussion with Professor Philip Baker when we were preparing the Vodafone case about tax deduction at source provision, which India had made. And I said, how will you apply it if there is a transaction between two foreign companies, A and B, outside India? How do you apply TDS to that? And he said, exactly. The question is not whether it's constitutional or unconstitutional. The question is, how are you going to recover tax? And I think somebody should have thought of it carefully. We then go back to tax by tyranny, saying, oh, we know how to recover. We know how to wield the stick. That approach has to be now given up for a tax by consensus, is my understanding. If India is so proud that we have leapfrogged into the digital economy and we have leapfrogged into the digital world technologically. I think we now need to leapfrog into the finances and into the leapfrog into the taxation of digital economy. Let's do ourselves proud even there.
Thank you, sir. I wanted to also build on one more theme about the certainty or otherwise of the dispute resolution mechanism in India. And I'm glad you talked about your experience with the treaty-related mutual agreement procedure. There is a growing feeling that if we look at our directive principles, particularly Article 73, it ties in with the international convention law making power of the parliament. So there is an international convention insofar as the power of the parliament is concerned, but there is also a directive principle which talks about settlement of dispute in an amicable manner. Perhaps the people who drafted the constitution in those days had in their mind resolution of disputes vis-a-vis interstate issues on sharing of water or resolution of international border disputes. But there is a growing feeling, and I have unsuccessfully tried with my friends at North Block to convince that directive principle itself is very good ground for India to embrace mandatory arbitration in its treaties. What are your views on that, sir, if the Indian government seeks your view?
See, my view is based on two broad principles. Dispute resolution by consensus versus dispute litigation is one of the banes of Indian governance. We have unfortunately reached a mindset, not just in taxation, and we've created a very oppressive regime in India by which even tax officers say, we don't want to take the risk of taking this view. First of all, we have to do away with this sense of disbelief and distrust in our own system. And we have to embrace dispute resolution. And you're right, the framers of the Constitution, we picked up our the philosophy of directive principles of state policy from the Irish Constitution. And they must inspire governance of India. And one of the directive principles is amicable resolution of disputes. When the Constitution was written, who were the big owners of resource? The biggest resource was land. And the governments were owners of land. Water for irrigation. The governments were the trustees of water for irrigation, etc., etc. Today, what are the resources in the digital world? Resources have changed dramatically. The world is a different place. The whole idea is where it relates to sharing of large economic resources. The approach should be of consensus, not confrontation. The approach should be of a partnership and not of a rivalry. You cannot be at war with your taxpayer. I always say, if there was no taxpayer, there would be no tax department. And if there was no tax department and no government, the taxpayer would have no income. Neither of them can survive without the other. Be brothers in arms, don't be enemies.
Thank you, sir. Sir, since you mentioned about the GAR and the anti-abuse provision, there is still a perpetual debate in India whether the Aadhaar Bachao Andolan case is correct reading of the McDowell case. This is despite the fact that in Vodafone case, all these were rejected. In fact, I remember that in Vodafone case, the government insisted on a larger bench to examine because there could be frictions arising. Now, notwithstanding this argument, the question that has arisen is that the GAR law that came in India as a reaction to the Vodafone case, how will the future administration, actually, how will the future judiciary be interpreting the law from a purpose test standpoint? So this debate is a little bit muddled up right now, because from April 1, 2020, when India has become a part of the multilateral instrument and it proposes to implement what is called a principal purpose test in all its treaties. Now, given that the MLI has the backing of most advanced countries, do you think that the form versus substance debate is concluded in favor and the Duke of Westminster principle is no longer in vogue?
The English courts have to discover some principle to resolve the complex issue of should illegal arrangement be allowed to be recognized for tax, or should it be open to the tax authorities to redesign transactions based on some understanding of what is reality versus what is substance and what is form. I think once the GAR is in place, and this is my opinion, judicially evolved standards now stand displaced by statute. So I think we can give the McDowell judgment and the controversy as to whether it has rightly or wrongly been understood in Vodafone. We can give that controversy a decent guidance. Let's now focus on GAR, which is a written word and is relatively uncertain. I'm saying relatively uncertain. And as you rightly said, the MLI, which has now come into being, which sets out its own principles. So I think while it is always interesting to write articles about the law that has been, we should leave all that behind, because what you have is the legacy of a very muddled state of law. And what you have on the other side of the fence today is statute, GAR, and a multilateral instrument. I think those should be now the new paradigms by which we resolve this unending controversy of avoidance versus abuse.
Thank you, sir. We would have liked to go on, but I would still seek your indulgence on one last question. So this question has got to do with what you referred to, but was also the theme of our webinar series, which is that there is a treaty law and there are definitions within the treaty law, and then there is a domestic law. Sometimes changes in the domestic law because of the sovereignty principle do cause friction with the treaty law, and the court has to then interpret this. To some extent, we debated the Fowler case versus HMRC But a parallel to that, sir, is a case which is very close to your heart, the Sanofi case, which, as you know, after the amendment to the Indian law, has come in friction with the India-France treaty. So as it stands now, the decision is largely is in favor of the taxpayer, and it is before the Supreme Court. But leaving the debate aside, sir, what is your overall view on dealing frictions in the domestic law, which cause a friction with the treaty? Because many commentators believe that it comes in friction with the good faith principle of the Vienna Convention on Law of Treaties.
In fact, Mukesh, it comes in conflict, in my understanding, on a more fundamental principle. In public international law, domestic law is never a defense. Be it a bilateral investment treaty, be it a trade treaty, and I don't see why we should be any different for tax treaties. Domestic law comes below public international law. When you're interpreting a tax treaty, we must always remember, even if you're a tax tribunal who statutorily are construing a treaty, or a court hearing a tax case construing a treaty, those are the limited areas in which domestic courts have to apply treaty law. And where it comes to applying treaty law, we can have two models. One is you have the statute itself in certain areas. For example, extradition is a treaty, but then extradition provisions are statutorily enacted. The New York Convention for Enforcement of Awards is a treaty, but that has been statutorily enacted. When that happens, while you may look at the treaty for construction purposes, what you are bound by is the statute. Our tax law has a provision by which you apply the treaty on its own. So you are in the realm of public international law. So conceptually, I find it very hard to accept that a definition in a statute would override the definition of a treaty, unless the treaty itself incorporates it by reference. A treaty may say, for example, a particular income shall be based on the definition in the domestic law from time to time. Then the treaty is allowing the domestic law area of play. But the treaty is, as in the Sanofi case, or the treaty as in the Fowler case, stood by themselves. And this can cut both ways. If you know Fowler, the citizen wanted to the taxpayer wanted superimposition of the British law on the treaty, saying under British law, this is income from a profession or self-generated income. This is not employment. And of course, as he's entitled to, he would have fallen then away from both, because under the British tax law, he would have been taxed in South Africa. And in South Africa, this was income from employment. So he wouldn't have been taxed in South Africa either. But what the English court then said is, when we are reading the treaty, we are reading the treaty. When we read the tax law, we'll read the tax law. And under the treaty, because we have to again remind ourselves, the treaty broadly defines jurisdictions. Your domestic law comes below that. So if you have by international treaty agreed that I will tax these incomes, and by statute, you have made that treaty enforceable in domestic law. And the first question is this income within the ken of Indian taxation or within the ken of British taxation? And for that, you look at the treaty alone. If it falls, then how it is to be taxed, your tax law applies. So if you look at it logically, unless the treaty incorporates definitions, domestic law cannot override treaty. Now you can knock out section 90 and say, I will not have treaties enforceable in my country. Do that if you will. Other countries will do the same. But then that's not the way forward. The very fact that you have treaties, see, the most important thing about global international treaties between sovereigns, what are you going to do if there's a treaty breach? Wage war? You're not going to wage war. The Vienna Convention has the good faith principle, means if you have entered into a treaty, for God's sake, don't allow domestic passions and domestic pressures to overcome your treaty obligations. If you keep that broad philosophy of public international law in mind, a lot of these issues get resolved.
Wow, what a Pleasure and delight it has been, sir. Despite not being a journalist or in the journalism profession, you rarely get to pose questions to India's leading jurist. We are grateful and obliged for your participation. I'd like to express a vote of thanks on behalf of IFA, the Executive Committee and its members. And for rest of the participants, it's been an absolute pleasure hosting you in the last 2 weeks. We look forward to working with you, and I'm glad. I'd just like to close by thanking to all our academic institutes supporting this event, the Vienna University, the University of Lausanne, Gujarat National Law University, Tax Sutra, Foundation for International Tax, UK Chartered Institute of Taxation, and the Bombay Chartered Accountant Society. So with that, we have come to the end of excellent sessions. Thank you very much, sir, once again.